So today's session will be over year-end planning and tax considerations for the business owner, and is presented by Salvatore Russo. He's a CPA and partner at Presti Naegele. He's a valued partner for Zoho, and he's also a valued partner at his firm. He's actually been there for roughly almost going on 20 years, and we'll introduce him here in a little bit. We kind of have his own slide, talks a little bit more about him. But before we do that, we need to go over a few housekeeping items. So today's session is hosted by the zoho.com/CPA. We are the finance partner team over here at Zoho, and I'll let Val talk about that here in a little bit, but let me keep going through the housekeeping items. All accountants and bookkeepers are welcome as well. Today's presentation is presented in Showtime. If you have any questions, go ahead and post it in the questions panel on the left-hand side. And as I was mentioning earlier, we have some really great handouts right now. We have obviously Zoho handouts as far as Zoho books and our partner program. But I also posted in there the Presti Naegele newsletter, which they have monthly newsletters, and they have topical information about tax updates and also ways you can benefit and grow your business. I also included the presentation slide deck in there as a handout, and an article from Forbes talking about why it's important to work with an accountant. Today's session does qualify for 1 CPE credit. So if you're an accountant and you need that credit, you need to attend for at least 60 minutes, answer 3 out of the 4 polling questions, and fill out the evaluation at the end of this session after I end the session. Also, anybody who's attending, we ask that you just fill out the evaluation just because it helps us improve our presentations going forward. Here is an example of a poll question, and it's just kind of a silly one just to kind of lighten the mood a little bit. But what is the Rock the Dwayne Johnson's net worth? He is a very important person in the Hollywood community for sure. So I would think he would get paid a little bit, but yeah, the answer is 400 million. So congratulations to those who got it right. I don't have any awards for you, but congratulations. You can tell your friends about that one. And so let's go ahead and introduce the Zoho team. So we have Val Steed, who is our resident CPA, and I'll let him kind of tell us a little bit more about himself.
Hello, everyone, and welcome. We are the accountants team, as Nathan has mentioned, at Zoho. We started a few years back, and one of our goals as an accountant-focused, CPA bookkeeper-focused group is we're looking for topics to also help folks, which is why we have this session today just on tax. So our marketing group, we're not really focused only on product and sales and marketing. We also have had a number of sessions. Presti Naegele has been very good to support us on PPP events and tax events, other events. So we're very thrilled today to have Sal here and talk to us more about that. Our team's a small team, but growing team. If you're interested in the finance area, we do have a website, zoho.com/CPA. And that, don't be offended by that, by the way. We just had to pick one abbreviation in there to set the website under. So we use CPA, but it really is for bookkeepers, finance professionals, accountants, CPAs, anybody that wants to kind of join our club, be part of our partnership group and get some benefits therein. That's the site you go to help you focus. And the reason why we have that site is Zoho has over 40 plus applications. So our site is kind of more focused on the finance suite and really kind of focused in around about 7 or 8 core apps that are part of that group. So welcome.
Yeah, thanks for that, Val. And my name is Nathan Rogerson, and I'll be kind of in and out of this session today, posting poll questions and communicating with Sal as well as he goes through the presentation. But he has a lot to cover, so let's go ahead and introduce Sal. Like I mentioned earlier, he's been with Presti Naegele for almost 20 years, which congratulations with that. He's been in the accounting industry for over 20 years, and I'll let him tell us a little bit more about himself and Presti Naegele.
Thanks for the introduction there, Nathan. So I've been practicing in public accounting for, I would say almost 25 years now. And I've been with my firm for 20 years. Our focus is on small businesses and small business owners. Although we have clients of all different sizes, as you can imagine, over the course of 40 years that the firm has been in existence, our smallest clients 40 years ago are some of our largest clients today. And that's really rewarding and gratifying to see them grow. We look at all our clients as partners. It's a partnership. We realize how valuable they are to us, and we recognize that if they don't grow, we won't grow as business owners ourselves. So we truly do take a very involved approach. We roll up our sleeves and get involved with almost all aspects of our clients' businesses. And that could be tax compliance, that could be running day to day and helping in management decisions. I myself have experience with large and small clients in an array of different industries. We don't focus on one specific industry per se. We have a lot of experience across all different industries, and whether it be a retail storefront to e-commerce and professionals, and you name it, we've seen it. So there's a lot of different areas that we can help clients with.
Yeah, appreciate that, Sal. And
Sure.
I'll go ahead and let you get started with your presentation. I know you got a lot to cover. There's a lot of bullet points for sure, and it'll be very valuable for any small business owner or any accountant that's in this presentation as well.
Yeah, definitely. Yeah, let's kick it off.
Oh yeah, let me go ahead and send you control right now, so you can kind of go through the slides. I think that
Yeah.
would be best. So I transferred control, and you can turn on your. Hold on. Hold on.
So I don't see the slides up on the screen. Am I?
Oh, you don't see the slides up on the screen here?
No.
Here. Can you try to refresh your screen? Sorry, Sal. Sorry, all the attendees.
Yeah, just a quick little tech control issue here, folks. We'll be rolling in just a minute. Nathan, there was also a comment about checking on the handout when you get a second. Once we get Sal up and rolling here.
Or it looks like he's back in.
Okay. Yeah, folks, just hang on there with us a little bit. This does happen with technology. It never seems to fail. Whenever you want to show somebody something cool or get in the middle of a presentation, that's when stuff kind of hiccups a little bit. So hang in there. We'll get this rolling. So yes, the answer to that is the session being recorded? Yes, it is. And that recording, the link for that will come out later today after the session is done, closed up,
awesome.
wrapped up, and that recording will come to you. Yeah. So yes. Also, if you're looking for CPE,
can you guys hear me?
Sure.
Yeah,
we can. So
great.
If you're looking for CPE, make sure that you answer at least 3 of the 4 polling questions if you're a person that needs that CPE credit. All right, Sal, have you got a hold of that thing?
Yeah, let's I'll launch the first poll question. Sorry about that, and then Sal will get going. I should have done why he was going. But
so here's the first of your 4 polling questions we'll have today. And this is for NASBA for CPE credit. Continuing professional education for those that need it on the event. I'll even put up a little chat here about that. For those that don't, you can either answer the polling question or not. Doesn't matter. I mean, it's just kind of all for fun.
Yes, it definitely is for fun if you don't need it. All right, awesome. It helps Sal also at whenever we're going through the presentation. I have some that's a little bit about the conversation he's talking about. So let's go ahead and start it off, Sal. Sorry about that, everybody.
No worries. Sorry for the technical difficulties, guys. All right, so let's just jump into it. I have a lot to cover. Everyone's going to get the handout, the presentation at the handout area. So there's a lot of information in here. I may not go line by line, but my intention is to at least do a nice overview of all these issues. So today's learning objectives, we want to get your books in order. We want to go through what you should be doing to project your year end. To that end, we want to talk about year-end transactions we want to consider. I'm going to do an overview of the recently passed Infrastructure Investment and Jobs Act. In there was a reason. There was a change to the employee retention credit, so I want to just do a quick refresher on that. I know a lot of clients, businesses, business owners out there that have not yet addressed that. So that's a really valuable federal credit we want to make sure we're all aware of. And then lastly, the Build Back Better Act, which is on the table, and the House is voting on that this week, or supposed to be voting on that this week. So let's dive right into it. So, starting point in making any decisions is having the right data and information to be able to make those decisions. So the first thing you want to do is you want to get your books in order. You want to tackle updating your books and records. A lot of business owners get busy during the year. The holidays are the perfect time to pour yourself a nice cup of coffee or tea, sit in front of your workstation, and get cracking on your books and records. Bank reconciliations are especially key. A lot of times when people call me, first question I ask them is, are your books updated and are your bank recs done? Because that's where we start. Again, can't have a discussion about what to do from here if we don't know how we got here. So we want to make sure your bank reconciliations are done. Business owners always forget about out-of-pocket expenses. It's really easy to capture all the business expenses that occur in your checking account or your business credit card. What about money that you've spent out of your personal account, a personal credit card you've laid out? These are all things on your laundry list of items you want to address. So this way, there's no surprises in January, February when you close out your year and you say to yourself, "Oh, okay, well, yeah, I spent another $20,000 in inventory. I guess I didn't have to because I had $20,000 of expenses that I laid out of my pocket that I had forgotten about." So,
Sal, let me add one to that too. From when I was in public practice, one that clients would often forget is mileage logs. If they were those that needed to track mileage, they would
right.
often come into your meeting and not keep it. And from what I remember, now correct me if I'm wrong, you're currently practicing. I haven't practiced for a number of years, but I think just even a manual little log is fine to track the miles. So you have a summary of some kind to prove to the IRS, correct?
Oh yeah, absolutely. That's very sufficient. Some kind of record of tracking the mileage is fine in any form. A lot of clients I know, they just maintain their calendar, their Outlook calendar. I have one client who he actually records inside his calendar appointments, the mileage. So these are all tools that you can use to because let's face it, I mean, the old way of carrying a book around and logging that in, it's tough. There's a lot of software out there that will help you keep track of things like that, as well as keep track of receipts, the out-of-pocket expenses, for example. There's a lot of third-party softwares out there that can help you with that. Taxi
Yeah.
receipts,
Yeah. Forgive me for one here. Hint, 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 Zoho expense. We do all that. Mileage,
right.
cash receipts, all that stuff. Sorry, folks. I couldn't resist. Go ahead, Sal.
No problem. No problem. Owner contributions, right? You want to remember you want to make sure you have a good track record and good records of money you've put into the business checking account. You want to make sure you don't mistake that for sales, all right, or revenue. You want to set those aside and make sure they're allocated to the right accounts, to your equity accounts. Shoebox disease, as I like to call it. We just touched on managing receipts. You take a taxi, you fill up your car with gas, right? Again, use software, use technology to keep track of that. The old way of taking the receipt home, dropping it in a shoebox, you're just creating a problem for you later on down the road. The more you can handle in live time, the more you can handle live, the better your life will be at the end of the year. So that's something to get your arms around. And once you get there, once your books are up to date, it's time to project the year, right? So if you've reconciled your books and records through September, find out what methodology you should take to project the final 3 months of the year. If you reconciled through October, take care of those last 2 months of the year. You can talk to your CPA, you can talk to an expert about how to go about doing that. What do you anticipate? Your industry, your business size has a lot to do with that. A lot of people know their business very well. Looking at historical information will help you to project what's going to happen the rest of the year. That'll give you a finish line, an expected finish line, and then you can make decisions based on that. And of course, enlist the assistance of a pro, a Zoho pro, as I like to call us. So, or your CPA, like Presti Naegele. Once you get to that point where you've projected your year-end profit or loss, it could go either way. Let's hope it's profit. These are some of the things to consider at that point. Mitigating taxes is always the name of the game. There's a couple of things in here which may not be tax liability related. First and foremost, your paycheck protection plan forgiveness. You're going to want to address that before the end of the year, especially if you have a basis issue. Basis issues have popped up and reared their ugly heads over the last 18 months because of this paycheck protection program. What's happening is when you are granted forgiveness, you're creating non-taxable income in your business. Whether you're a pass-through, an S corp, LLC, what have you, what's happening is you're creating non-taxable income. The business owner is certainly entitled to pull money out and distribute some of the profits, some of the business profits. In some cases, you might over distribute money to a business owner above and beyond the profits generated by the business. If you have not obtained your paycheck protection plan forgiveness yet, you might be in a situation where you have zero basis in your S corp or negative basis in your LLC. This is an important thing. Nowadays, a lot of the PPP loans that business owners have taken some have been sold off, some have been transferred to other banks. The SBA has opened a direct forgiveness platform where you can go to the SBA website. You don't have to go through your bank and apply directly for forgiveness with the SBA. It's faster. Normally with a bank, you have to apply for forgiveness directly to the bank, and then it could take the bank 30 or 60 days to apply to the SBA and get clearance. This puts you right in front of the SBA and gets your forgiveness done as soon as possible. So I urge all the business owners on this call that have obtained PPP loans to rush to the SBA website to see if you're eligible to get direct forgiveness. No sense in waiting, get it off your books. The pass-through entity tax, this is pretty big here in New York. Just recently in the last month or two, approved a pass-through entity tax for New York State. The election was due October 15th. Nationwide, we have pass-through entity taxes that have been passed by various states. I know New Jersey has one, and there's a laundry list of other states. Please check your state to see if your pass-through entity qualifies for that. Very powerful pass-through entity tax deduction, which came about combating the limited SALT tax deductions that came around as part of the Tax Cuts and Jobs Act of that took effect in 2018. So you're going to take a look at that. That basically enables you to sidestep that SALT limitation, generate some state and local tax deductions for your business, which passes through to you, of course. And in almost all situations, the individual that is receiving the profits from that business will receive a state credit for the pass-through entity tax that was paid. So you're basically floating money to your state, getting that money back months later on your individual tax return, and you're obtaining a federal tax deduction for it. Very, very powerful. Please take a look at that. Presti Naegele is always available to help our clients through that. So if anyone's in doubt, please give my office a call. Some of these other items are things, it's not magic, it's not rocket science. Buying office equipment, machinery, and certain qualifying vehicles. This stuff's been around for years. As we get to the year end, we want to buy things that we can depreciate very, very quickly. We talk about spending some money to generate tax deductions. We don't want to cut off our nose to spite our face. We don't want to give our money away or spend our money unnecessarily, of course. But I urge business owners to look out 6 to 8 months and identify certain capital transactions, certain purchases that they may need to make anyway. It might be time to consider accelerating those purchases, getting those assets into service in 2021 to enable you to take advantage of bonus depreciation, Section 179 depreciation with vehicles. It's been around for years. Very, very powerful deduction here. Obviously, machinery and equipment, that's some obvious stuff. You're going to want to make sure you place it into service for December 31st, and you will get 100% deduction for the cost in 2021. For those cash basis taxpayers out there, some common strategies that business owners employ. They might delay some billing to customers and clients to slow down cash collections. They might pay bills. They might accelerate payments, paying down some accounts payable, prepaying some rent. These are all movements you can do, you can take to accelerate expenses into 2021 and defer income into 2022. You're not creating tax deductions. You're not eliminating taxable income. You're basically deferring and accelerating. Just know that if you have a huge bill that you're paying for $50,000, you decide to pay it in 2021 as a cash basis taxpayer, just know that you're not going to get that deduction in 2022. So, think of it as an interest-free loan on your tax bill. This is a nice little example of a prepayment rule. The IRS offers a lot of safe harbor situations. I'm not going to get into the weeds too much on this, but this is just an example of prepaying expenses. It gives the example of rent, which is a very, very common strategy that a lot of business owners take. Prepaying rent, you can prepay 12 months in advance. You secure a deduction. The landlord will report that as income in 2022 in the subsequent year. This lays out all the rules. As long as everyone plays nice and you make your landlord aware, by the way, that you are planning on prepaying the rent, make them aware so they don't send a check back or rip it up and think you made a mistake. If they don't cash that check, that's a problem for you. You want to demonstrate constructive receipt that the landlord received that check for the prepaid rent. But I urge everybody, please read through these details here. But like I said, the overview of this is basically you're prepaying a year's worth of rent. You're securing a deduction here. Yet again, what you're doing is you're accelerating an expense. All right, you're not creating an expense here. So that's important to think about because that chicken will come home to roost in 2022 when you don't have a rent expense deduction. And by the way, accrual-based taxpayers, this doesn't apply. This is only related to cash basis taxpayers, as you can see in bullet point number 1. Some other powerful deductions here that we can take advantage of before year end. Qualified improvement property for all my audience members who are in the commercial real estate industry. And whether or not you're here for your business, but you just happen to have commercial rental real estate that you're managing as a side business here, this is a really powerful tool. If you acquired a commercial property, a couple of years ago, as an example, and recently, within the last year or two, let's say, you built out the inside of the commercial property. You were bringing in a brand new tenant for a brand new lease. Part of the lease provision was that you, as the landlord, would have to pay for some repairs or for some improvements to the inside space. We're not talking about structural. We're talking about anything inside the building. Those are all improvements that would qualify as qualified improvement property. It would qualify as 15-year property, as you can see in bullet point number 2 here. And that's eligible for immediate deduction using 100% bonus depreciation. So if you had to spend $20,000, $30,000, $40,000 building out the inside of your commercial property, that's something that you can deduct immediately versus hanging it on the shelf and depreciating that over 39 years. This was something that came about as part of the Tax Cuts and Jobs Act and was further clarified through the CARES Act of 2020. Previous to that, it was 39-year property as commercial improvements. What's even more powerful, if this happened in 2018 or 2019, you have an opportunity to go back, amend your 2018 or 2019 returns, or you can fix it on your current year return with an accounting change. That's that Form 3115 that I mentioned. Oop, sorry. Got a little ahead of myself. That's Form 3115. That's the accounting change form. So it's really a question of strategy and what's going on at the moment. You might want to fix your old returns to get some old refunds back. You might just want to take those deductions on your 2021 return or 2020 if you haven't filed that yet, or amend it. Everyone's situation is different. How would you know which way to go on that? It really matters on a lot of factors. I like to look at it and ask the question, where's your tax rate the highest? If you can do an accounting change in 2020, for example, and your tax brackets were higher in that year, you're eligible to make an accounting change that year. So there's a little bit of an advantage there, a little bit of a financial advantage. We don't want to split hairs if it's not worth doing, but doing the analysis. You might want to go back, on the other hand, if your tax brackets were higher in the older years. So those are all things that we want to talk about once we get into the weeds. And just the last 3 bullet points on this slide, harvesting capital losses. This is more of an individual income tax planning tool. I wanted to throw this in there because of all the success that the market has brought a lot of people that have portfolios this year. You might have had a lot of realized gains. You want to look at your unrealized losses, maybe liquidate some of those positions. If you like the position that you have, but you'd still like to liquidate it because it's an unrealized loss, you could always reestablish the position 30 days later. You want to avoid the wash sale rules. Be careful of that. You can't sell a stock at a loss and deduct it if you reestablish a position within 30 days after. So you just want to be careful of that. And the last 2 things, address your retirement planning. I mean, that's a simple thing, right? At the end of the day, when you know what your profit is, let's talk about how much you'd like to put away. I always start with that question with a client. Forget about what kind of plans are out there and what should I choose. Let's start with how much money would you like to put away? Because that's a wide range. And then we engineer and tailor make your retirement plan to fit that metric. And last but not least, this is something a lot of people don't think about. You might want to convert your IRA to a Roth IRA in a low income year. Take advantage of a low tax bracket whenever you see it coming your way. Convert that IRA money to a Roth at a discount. The theory is later on in life, when you take those IRA distributions, you might be in a higher bracket, you might be in a low bracket, but all that appreciation between now and then, you're going to pay income tax on it if you leave it in an IRA. So I would love to pay some low taxes on converting my IRA.
Yeah. Hey, Sal, I wanted to jump in here and launch the second poll question. And I mean, all those are valid points to kind of point out about like how you can reduce the bottom line on your end so that at the end of the year, your taxes are a little lower. But this was an open response. It's just kind of having people just type in what they thought. This is kind of a new technique because you had so many transactions to consider. I was like, well, I might as well just let them kind of tell us what they think. And if you're here for the CPA, you can just post, CPE, if you're here for that, you can just post anything. It doesn't have to really be that. But prepaid expenses, prepaid 2022 expenses, bonus appreciation. Obviously, that's a big one. Pay off existing payables, purchasing new equipment, harvest capital gains. I'm just kind of reading off some of them. And like I said, if you're just here for the CPE and you having a hard time thinking about those transactions to consider, you can just put just an answer. But
yeah, these polling questions, folks, are they're to check off and make sure that technically you're still listening, you're still there and on the event, so that we can actually issue continuing professional education credit.
Yeah, for sure. And I'll give this about 10 more seconds, and Sal, you can continue. going on. What do you see the most with your clients as far as these additional transactions? Whenever your clients come in, y'all do your analysis on how you can improve by lowering their taxes. What have you seen the most kind of this year and last year?
Yeah, I mean, annually, we always talk about buying equipment, vehicles,
Mhm.
for our clients that are in either, I mean, the prime example I have is I have a client, a family business. They're in the oil industry. They sell heating fuel. So routinely they're in the business of upgrading their equipment, upgrading their vehicles. As you can imagine, their delivery trucks are they're put to a lot of usage. So
Yeah, definitely.
so that's something we talk about every year about updating their fleet. Um,
Are they mainly leaning on 179, Sal, for that?
yeah, definitely, definitely. They a lot of these 179 rules, the bonus depreciation rules, you have to have a heavy vehicle, 6,000 pounds or more.
Right,
So
right.
with them, they have these large trucks that works very, very nicely for them. This year we've been talking a lot about the pass-through entity tax. Almost all clients that have a pass-through business have elected to pay that tax. That is huge. Paycheck protection plan forgiveness, that's been huge
Right.
this year. We've been
Mhm.
knocking all those out for our clients. And a strategy that's been working for decades is delaying billing and accelerating payables. That's
Right.
always something that
For cash flow or cash-based
cash
taxpayers.
basis.
Yes.
Yeah, clients
Yeah.
learn that on their own.
Right.
Basically, they've been trained to think like that. So those are the things we see that are very popular. Another popular thing that I didn't. It's not actually that popular. I didn't put on my listing there, but there is. If you're in a business where you hold inventory at the end of the year, I mentioned the accounting change form 3115 earlier. You can actually elect to write off the value of your inventory at the end of the year. It's basically you're electing to change your accounting method of inventory, um, basically taking a cash basis approach. So that's something pretty powerful.
Mhm.
Mm.
Unfortunately, I didn't list that on my slides. That's actually a good one. I
Yeah.
apologize to the audience, but
No. You mentioned it, and I'm sure you'll have a newsletter about it somewhere. I would
yeah,
imagine.
we did put out a newsletter about that. That was something that came out with the Tax Cuts and Jobs Act,
Yeah.
effective 2018. But that's really powerful. If any of you are carrying inventory in your businesses, please reach out to me. I'd love to talk a little bit about there and explain how that affects your specific situation. But essentially, you could write off the inventory you're carrying at the end of the year, which you can imagine. Just take your inventory balance at 12/31/21 and imagine you just generated another deduction for yourself. That would be 50 grand, 100,000, 500,000. That's a big, powerful tool there.
Yeah, definitely.
Yep.
Yeah, so the poll question's over, so you can continue, Sal.
Great. All right, great. Let's jump into this Infrastructure Investments and Job Act for a moment. This was a law that was just signed into law recently by President Biden. Doesn't have a lot of significant tax consequences, but the one that it does have is pretty impactful. The Employee Retention Credit, which was extended through the end of 2021 originally. This Jobs Act scaled it back through the end of the third quarter. So different people are in different situations here, but the last bullet point on this slide, I wanted to point out that if anyone's business, if you're with a PEO service for payroll, it's quite possible that whatever employee retention credit you were entitled to, your PEO, which is a professional employer organization, they may have already reduced your weekly payroll tax obligations for your ERC that you were entitled to. If that's the case, you're going to want to contact them and speak to them as to how that gets reconciled. But what's going to happen is you're going to have to make up the tax withholding that you were supposed to pay in, which was being reduced by your employee retention credits. So just talk to them about how that's going to be made up. For anyone that hasn't claimed the ERC yet, this here is a quick refresher on it, and I've got 2 slides here on this. This first slide just walks you through the qualifications for the credit for 2020 and 2021. We highlighted this on one of our prior Zoho webinars, and I just wanted to highlight this again so everybody has it in front of you. Again, you don't have to read every line item here. Please read this after today's presentation. Become familiar with it if you're not, and definitely speak to your CPA or tax preparer about this credit. It's very, very powerful. 2020 itself, I'd like to point out that basically if you've paid more than, well, $10,000 or more to each employee for the calendar year, you're entitled for a 50% credit of whatever wages and health insurance, by the way, that you've paid for your employees. So basically what that means is you get $5,000 for each employee that you've paid wages to. That's pretty powerful. So you can do the multiplication and figure out what kind of a credit you're entitled to. In 2021, it's even more powerful. What the federal government did was they expanded that. The qualified wages limitation is still $10,000, but they did two things to increase the value here. Number one, they allowed you to take a credit of 70% of the wages paid. So that's $7,000 per employee. And they expanded that not just for the calendar year, but they allowed you to take that credit per quarter. So now you've got $7,000 a quarter coming to you. For each employee, you paid at least $10,000 in wages or healthcare insurance on their behalf. I mean, if you add this up, 3 quarters in 2021, you can get up to $21,000 per employee. You got 10 employees, that's $210,000. You guys need to jump off this webinar right now and run and file those returns. I mean, I'm kidding, stick around. But after this webinar, the first thing you should do is place a phone call to your CPA or to your payroll company and ask them, hey, what do I do to get this credit? Let's get this going. I need that money. The IRS is backed up with processing amended payroll tax returns. But, the sooner you get your amended returns in, the better. You're not going to lose out on the credit for the end of the year. There's no hard deadline. You can file an amended return this month, in December, in March of 2022. I would not wait because, as you can see, they scaled back this ERC to end in the third quarter. They could very possibly do something to this with new legislation coming through, scale it back even more, retroactively limit it. If everyone remembers with the PPP, they were constantly changing the game a little. They were, the goalposts were moving. Things were getting better as with each legislation and with each rule change, thankfully for our benefit, but it could very well go the other way as evidenced by the infrastructure bill.
Hey, Sal, I'll go and launch the third poll question. I promise this one is easier for everyone.
Sure.
It's not a text box, and it's really about the employee retention credit and just seeing how comfortable people are with it.
Sure. In the meantime, one of our audience members asked about what's the contact information to discuss the ERC. I'm gonna put my name in here and the answer key. I'm assuming they're looking for my contact info.
Yeah, put your email as well in the chat. But I believe, at the end of the session, we'll obviously share your email and everything as well.
Sure.
So I'll leave this up for about 10 more seconds. But yeah, I remember whenever obviously we had y'all on for the PPP and we did our own PPP one, and we were kind of the mind to kind of file for the PPP loan, and I guess reap your basically whenever y'all came on, you were telling people, hey, just kind of wait it out a little bit to see how it kind of plays out, and y'all were actually right on that. And I just remember me being like, kind of like, why would you wait for this? And then y'all were right. They came out, and actually it was beneficial for a lot of businesses, and they ended up paying a lot more back on that PPP loan than people initially thought. So that was good insight from y'all back then. Yeah, so it looks like the poll's done, and you can continue, Sal.
Great. So this second slide on the ERC, it just has some helpful hints about what to do, how to do it. Like I mentioned, if you use a professional employer organization, please reach out to them about claiming the credit. Here's a big thing to note if you weren't already aware of it. Any wages that you use to qualify PPP forgiveness, you're not going to be able to double dip and use it for the ERC. A little bit of math and strategy go a long way here. I want to make sure that everyone's aware that this is a little bit of a balancing act. So if you haven't already filed for PPP forgiveness and you're going to jump at that after this presentation, just know that jumping at the ERC, you're going to want to do those things in a balancing act. The PPP, you were able to use 40% to qualify 40% of the PPP forgiveness. You were able to use non-payroll related expenses like rent and some other overhead. You're going to want to maximize that 40% and keep your wages to only cover 60%. That's going to go a long way to maximizing the ERC. So the other thing I want to point out is when in doubt, use $1 of wages for the PPP because the ERC, you're getting 70% coverage for 2021 in the form of a 70% credit, 50% coverage for 2020, whereas the PPP, you're getting $1 for dollar forgiveness. So I threw a lot at you guys just now with this balancing act between the PPP and ERC. Once you go through the rules of the game on how to play each side of this, you'll understand what I'm talking about with the balancing act. And I don't mean to confuse you guys, but I do want to put a stop sign up so this way you do evaluate that balancing act because it's going to mean real dollars in your pocket. Like I mentioned, that third bullet point there, the ERC is retroactive to 2020. So if you passed on this credit, you can go back and amend payroll tax returns to get those credits. And of course, this is all confusing, right? So if you have any questions or you need more information on how to claim this ERC or PPP forgiveness and that balancing act that I mentioned, you can contact me directly to discuss your circumstances. Speak to your CPA, your tax preparer to really dive in and find out how to maximize your benefits here. So,
Sal, there is one question I think we ought to take live here. Somebody asked,
yeah.
Can you explain what happens when essentially a company or firm is merged with another one during the year for, I guess, PPP limits and ERC limits if they've joined firms?
Okay. So a lot of people use the word merge. I'm assuming that to answer this question, I would need to know whether or not this is a brand new business where two separate businesses merged and created a brand new business under a brand new EIN number, or this is really one business purchased the other business. The reason I present it that way is that the tax identification number is the controlling factor here. If you had a business that was acquired by another business, the business that was acquired, if it was an asset deal, and I'm really getting into the weeds here, if it was an asset deal, the business that sold their business operation, right, that shell, that corporation still exists under a tax ID number. That tax ID number, that shell corporation has to do their own forgiveness application. The new business that acquired that business asset, the name, the goodwill, the employees, etc., that's a separate business. That business has to deal with their forgiveness on their own, even if they may not even have applied for a PPP loan. But the former business has to deal with that.
I think it sounds like they really need, if they were in this situation, they really need to talk to some good advisors, right? I mean, there's more involved here than absolutely.
Yeah. And there's gray areas there. I'm sure once we get into the weeds there, I would say the tax ID number is the controlling factor. When in doubt, ask yourself who's got the tax ID number, because that's where the SBA is going to trace it back. But yeah, like Val said, speak to your CPA. You're welcome to call me and discuss that further. That's a bit of a conversation we're going to have. All right, so Build Back Better Act. Now, just to set the table here, this is not signed into law. This is being kicked around. We all know in the House and the Senate, when they go to vote on these bills, negotiations happen and things get changed. A lot of hearsay, a lot of, hey, I heard this from my friend, blah, blah, blah. What's in the bill? What's going to happen? These are the things that are not in the bill at the moment. So I wanted to kick these out immediately. And these are the things that scared a lot of us, right? Increasing the top ordinary individual rate back to 39.6%. The corporate tax rate going up as much as 28%. The increase in long-term capital gains rate and qualified dividend tax rate. Right now, we all enjoy a 20% maximum tax rate on long-term capital gains and qualified dividends. That's wonderful. Some of us even pay it at 15% or 0%, depending upon what your ordinary bracket is. That's not happening at the moment. The taxation of gains and capital assets at death. That was a big talking topic. Mark-to-market taxation on stock holdings. Not much chatter about that, but that was another dangerous provision that was in there. Different sides of the aisle on that, but depending upon your situation, you may not have wanted to see that. Section 1031 exchanges, the limitations were on the table. That scared the real estate industry to death. A lot of economists would argue that that would kill the real estate industry as we know it. That's not in the bill. Personally speaking, I agree with that. I was happy to see that 1031 provision, the limitation, was out of the bill. I thought that was a mistake. Provisions related to carried interest. We've all heard about carried interest in the past. Everyone's familiar with the terminology and the applications. So that was pulled out of that bill. And significant limits to the 20% deduction on pass-through income. They're talking about the QBI. Thankfully, that was kicked out. All my small business owners on the line here, we could all breathe a big sigh of relief there. And changes to the estate and gift tax exemptions. That was something that a lot of people were fans of. The estate exemption is at $11 million. I think a lot of people felt that could be lowered. The important thing to keep in mind is that any of these can get kicked back in. I don't think they're going to get kicked back in, but you never know what happens on Capitol Hill behind the curtain. Now that we've talked about what's not in the bill, let's talk about what's in the bill. A lot of information here, a lot of details, but the key things that are going to affect my small business owners on this call. Number one, a lot of these provisions are targeted at taxpayers with incomes above $400,000. So if you're above that, pay attention. If you're below that, you can exhale. First thing is a 5% surcharge on income exceeding $10 million, on individuals with income exceeding $10 million. So if your income's $10 million, wonderful, you get to pay another 5%. And if your income is more than 25 million, that's even great. It's even better. You get to pay a combined 8%. So for the Bill Gates on the call, sorry, that's some bad news. The other thing is the expansion of the net investment income tax. Right now, that's only paid on net investment income to the extent that you have it. There is a provision in the bill to include in that basket ordinary income that is earned in the ordinary course of a trade or business. This is again for taxpayers over $400,000. For single filers, for married filing joint, it's $500,000. This only applies to the extent the income is not already subject to payroll tax. What does that mean? Let me give you a practical example. You own a business and it's operated within an S corp as a legal entity. You pay yourself a salary. Maybe the S corp generates $200,000 of profit, and that's after you pay yourself a $100,000 salary. On the $100,000 salary you receive, it's reported to you on a W-2. You're paying payroll taxes on it. You're paying FICA. You're paying Medicare. The $200,000 profit that you receive from your S corp, you receive distributions of profit. The $200,000 was reported to you on a K-1 at the end of the year. Everyone's familiar with that as business owners. What they're talking about here is they're talking about this 3.8% net investment income tax being assessed on the $200,000 of profit. Again, this only applies to you if you're over the income limits here, the threshold of 400,000 a single, 500,000 married, filing joint. So if you are in that category, you can count on possibly paying this extra tax if this bill is passed in its current form. Be aware of that. It's an extra 3.8%, so it's something to consider. On the other hand, let's say you're not an S corp and you're a partnership or an LLC taxed as a partnership. This doesn't apply to you because the profits that you pay income tax on through an LLC as a tax as a partnership or a partnership as a legal entity is subject to self-employment tax. Self-employment tax is what they're talking about when they refer to this FICA tax. That's the current provision on the table right now. This really only affects my small business owners who are S corps. So keep that in mind. Now, the other provision that's pretty big is the disallowance of the excess business losses. Originally, as part of the Tax Cuts and Jobs Act, effective 2018, if you had a business loss greater than $250,000 as a single filer and $500,000 as a joint filer, you were only able to deduct that amount of a loss. So, practical example: you operate a business, you lost $700,000 in a year, gearing it up. Right? Maybe it hasn't generated revenue yet, whatever it might be. You were only allowed to deduct $250,000 as a single taxpayer, $500,000 as a joint taxpayer with this rule. The CARES Act temporarily repealed that. This act is looking to put that ceiling back on. This is really significant because under the original provision, any excess losses that you would not be able to deduct above and beyond this loss limitation, that was treated as an NOL, net operating loss. Anybody familiar with an NOL knows that it's very powerful. It doesn't. It's what I call it's non-discriminatory in the terms of what can I offset this loss against as far as income characterization. It's not a capital loss. It's not a business loss. It's a general ordinary loss that you can carry forward until it's completely exhausted. What this does, it doesn't even consider it an NOL, the unused excess. It continues to treat it as excess business losses. So it's subject to basis limitations. It's subject to a whole boatload of other hurdles that you've got to get through to deduct these losses. It's very restrictive. I don't like this. I hope that they really modify this slightly to either keep it as an NOL for the excess losses, if they're going to keep this in there, or just get rid of it entirely. Through COVID, we know a lot of business owners suffered a great deal of business losses. PPP loans and other government grants kept them afloat. Let's allow these taxpayers to deduct these losses. We gotta let business owners get back on their feet. So again, I don't like this. Hopefully it's taken out or modified, but we'll see what happens. Presti Naegele is going to stay on top of this. Like Nathan mentioned, we have our newsletters. Please feel free to visit our website, subscribe to our newsletters so you get the most current information as it's happening. A couple of other minor provisions that I just want to quickly run through because I know we're running short on time. We got about 6 minutes left here. They are talking about increasing the SALT limitation deduction from $10,000 up to $72,000. Read through that bullet point. It might even go up to $80,000. This is sort of going to work against the PTET tax, the pass-through entity tax that we talked about earlier in the presentation. They talk about a crazy number about prohibiting people from contributing more to a Roth or IRA. The number is $10 million. If you've got $10 million in your IRA, God bless you. I don't know if you need to think about making more contributions. The last thing that I don't like to hear is that there's significant funding in there for increased IRS enforcement, which could lead to more audits. So right now it's sort of been a free-for-all, I guess the Wild West, as some industry peers tell me. The police are back in town, I guess. And then there's some key corporate income tax changes. These are more for C corporations. I don't know if we have any C corp owners on the line, but there's a few here that I wanted to highlight. The most significant of which is the 15% AMT on companies with financial statements above over 1 billion. It may not affect anybody here, but these are really provisions to plug more money into the budget to pay for other provisions that might be there. That's the way I see it. And so with that, we are pretty much wrapped up. So any questions on any of this information? I threw a lot at you guys today. I apologize if this is overwhelming, but this is not the end of our conversation with you. Hopefully you guys reach out to me in my office if you have questions. We want to help clients navigate these muddy waters through the end of December, and then also as that Build Better Act comes into play, to help them be prepared for 2022 and beyond.
Yeah, and I appreciate you kind of walking through all this, Sal. I will launch my last poll question, and really kind of what Sal was saying. If you would like Sal to reach out to you, just go ahead and let us know through this poll question. He'll reach out. And also, here's his contact information. You can reach out to him as well. They're a great group and organization and partner of ours. And also, as far as tax advice, you can tell that Sal does his homework, and his Presti Naegele does their homework as well. So it's always good to have CPA advice.
Sal, thank you so much for your time. I know your time is very valuable, and we love doing these because we think it's very helpful for folks. And I really think today you were really spot on. A lot of this stuff is well done. Thank you. I appreciate your time, and thank you everyone for being here. I'll cut myself off here. Nathan, I'll let you close it up.
Yeah, I guess we have let's see here. I guess if we don't have any questions right now, like I said, Sal's information's right there, and you can reach out to him and also Presti Naegele. Just check out their newsletter; it's very helpful. And like I mentioned at the beginning of the presentation, we do have an evaluation at the end. If you are here to receive a CPE, please fill that out. And also, if you're just here to attend and having a good time with us, please fill it out as well. We appreciate it. Appreciate any feedback.
Just one last comment. I told you I was done, but right on the face of their website, folks, for Presti Naegele, you can sign up for the newsletter right there. You just go to their website and sign right up.
Mm-hmm. Yeah, Val put that in the chat. It's in the chat if anybody wants that. It's pntax.com. And I will end the session here. And thanks, Sal, so much. We really appreciate it, and we'll be in touch, okay?
You're welcome, guys. Thanks for having me.
All right, take care, everyone.